Hello everyone, this is Gaurav from Kuvera, and today I have Pratik Oswal from Motilal Oswal. He heads passives for Motilal Oswal. So which are the factors that you think investors are particularly looking at in India today?
Yeah, so I think globally, if you look at factor investing, the most sort of, I would say, popular or sought after factor is something called low volatility factor. What is low volatility factor? It's essentially a fund which, in a passive way, so in a rules-based way, there is no discretion of any fund manager who's taking a call about which stock to buy, which stock to sell. It's very simple. It's about buying the stocks which have the lowest volatility in the last 1 to 2 years' time. So it's very simple. So it's essentially buying steady stocks, buying consumer stocks which tend to do well in good as well as bad markets, consumer healthcare, that sort of industry profile. So that's essentially a very popular factor, because even if, in the US, for example, that factor has actually underperformed the index by a very small margin over the last 10 years. But if you actually, put a filter of risk on top of it, it's actually done really well in terms of risk-adjusted returns. So I think in terms of, in India, low volatility has actually done better in the index in the last 10-15 years' time. But what we've seen is that, it's a great sort of value add in the portfolio. It adds a lot of differentiation in your current existing portfolio, which will be, say, high in financial services, high in IT. This could add a very different flavor, while obviously keeping risk very low. So this is a very sort of popular factor today. The second factor which is very popular is something called a momentum investing portfolio, where you're betting on stocks which have done well in the recent past.
Right.
And that's a very interesting factor, because normally I think as someone from the AMC, we would discourage people from buying funds that are high returns, or who have done well in the last 2 to 5 years time, because the funds keep changing, the top performing funds keep changing. But what we've seen in momentum as a factor is that it looks at purely recent performance, and theory says that if stocks have done well in the sort of recent, say, one after 2 years time, they tend to do well in sort of the short-term future as well. And that is a factor which has actually worked well in global markets, in Indian markets, in different asset classes as well. So I think that's another very popular factor which is today, I think, liked by a lot of investors.
Just deep diving into the low vol piece a little bit. What's the intuition behind something like a low volatility factor? See, momentum factor, I think for a lot of people is fairly easy to kind of at least intuit, right? Because it's like a trend continuation model.
Yeah.
Whatever has done well will continue to do well, and as humans, we are anyways kind of wired to think like that. Yeah. We want to believe that the recent past will continue. So that's something that investors get very easily, right? And yeah. I think that's why, if I also see in the last 1 year, 1.5 years of data, momentum has been a very popular factor that people have accepted it because it's an easy factor to accept, right? But if you had to simplify low vol investing, right? Like, I mean, why would low volatility stocks do better, and how does it also reconcile with the statement that everyone talks about, which is that risk and reward are, high risk means high reward, right? Like at least that's what a lot of investors are made to believe. But this is where we are saying absolutely the opposite, which is that you're getting higher risk adjusted returns by going after low risk stocks. So for a common investor, what would be that intuition that will help them understand low vol factor?
Yeah, I think it's a very good question. So, and this is basically a huge, I mean, the right word would be anomaly in finance.
Right.
Where people talk about higher risk means higher return.
Right.
And if you're taking something which is higher risk, then you should ideally be compensated with higher returns, and which is what also makes sense, or at an asset class level, where if you're buying a debt instrument, the returns are going to be, say, 5, 6, 7%. If you're buying equity, which is higher risk, ideally you should be getting say 12, 13%. So it makes sense on an asset class level. But what we've seen is that I think because of people normally, what we've seen is tend to overlook stocks that are extremely stable, extremely low cost. So a lot of people who are interested in stocks, tend to go after the ones which are for example, momentum or high risk, because they believe that these stocks have a higher propensity to pay you large outcomes in the future. But actually, it's the boring companies, it's the stable companies that actually end up doing really well in terms of returns for investor over the long run. So something like a consumer company, which is growing at say 10, 15, 17% a year, is something which is often overlooked by investors because it's too low. But actually, because it's consistent in terms of the cash flows, because it does well in bear as well as bull markets, that is a huge reason to why this factor actually works out really well. So I'll give you a simple example of why this factor is actually quite efficient for investing. If you look at and if you divide the market into bull markets and bear markets, what we've seen is that if you lose money in a bear market, so if you lose say 25% in the bear market, to go up to the same, to sort of break even on your investing, you have to go up 50%. So returns are asymmetric. What that means is that if you lose say 25% of your investing, you have to go up 33% just to break even into your investing. So I think it's so, and that's something which investors don't keep into account when they're investing in equity. So what happens in a low vol strategy is that it actually works exceedingly well in a bear market, and not only a big bear market but also these mini bear markets that keep coming. In fact, even today, this year, a low vol strategy has actually been quite effective as the markets have fallen by 15-16%. So I think by losing less in bear markets, you actually have the ability to sort of win more in bull markets, which is why I think the strategy overall has worked out pretty well.
It's like the tortoise and rabbit analogy, right?
Yeah.
The rabbit is the hare, that's the sexy part of the market. Everyone's focusing on that, while the tortoise wins the race because it's slow and steady and doesn't stop.
Exactly.
Right, and keeps moving. Now that's a very interesting way of kind of putting it, and I 100% believe that everyone should have exposure in low vol. I myself invest in the low vol strategy. It's one of my favorite factors. Which factors are underrepresented in India? Like if you look at factor evolution in India, it's been very recent.
Yeah.
Very recently, we started having, I don't think we have a pure momentum fund. We have a low vol fund. Value is something that we have had for a very long time, but I don't think people look at value as a factor per se. Because it has such a long history, people think of value as a style of investing that kind of everyone knows of. Same thing with growth. But which would be that one factor that you think is not represented in India, or where at least retail investors don't have an easily available vehicle to buy that factor?
Yeah, I think, so factor investing is still in its very nascent stage, in the sense that there's not a lot of options out there. I think still, education is fairly limited. And I also believe that, in markets like the US, where factors are huge, you have trillions of dollars worth of investments in factor strategies, it's more or less adopted by fairly sophisticated investors or by investors who are advised by, say, some advisor. So I think that's where most of the popularity is. In India, I would say there's not a lot of options in value and quality. So if you look at the 4 of the most popular factors in the world, momentum and low vol is something which you have some options in India, but I would say value and quality is 2 factors which are still underrepresented. I think value globally
is represented as an active strategy. In India, value as an active strategy is very well represented because I think you have a lot of value funds, but
yes.
They're all active value funds.
They're all active.
But we don't have a passive value fund.
Yes.
Fair enough.
Yes. Yeah. So value is not there. Quality is also there. The thing about value and quality, unlike low volatility and momentum, is that there is an element of subjectivity. What is quality? What is value? Is something which, if you ask Warren Buffett or Charlie Munger, they would have a discussion on what they think is value, which they probably have a different definition. Charlie Munger would probably have a little bit of growth that's mixed into value, whereas Warren Buffett does not have that. So I think it's sort of subjective, and obviously now we have industry definitions of what quality is, what value is. But I think something which is more mathematical based is a lot more popular today, like low vol momentum. Whereas I think value and quality, I'll be honest, but maybe an active strategy makes a lot more sense out there. Because there you can sort of focus on that fund manager's definition of what they mean by value or what they mean by quality.
Fair. That was really interesting, Pratik. So that was our discussion on factor investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.